This is Commodity Wrap. I'm Tony St. James, and we wrap up a Wednesday. And what makes Wednesday kind of interesting, we get an announcement from the Federal Reserve on interest rates, and the announcement is no change. Of course, I don't think out of 100 people, only one person's surprised, because 99% of those polled through FedWatch expected no change, so really no surprise there for the market. Now, Dow, NASDAQ, S&P, positive territory. We bring in Brian Hoops. Brian is President, Midwest Market Solutions. Brian, I would imagine you're one of the 99 that are not surprised.
Yeah, I'd like to know who that one person was that would be surprised, because this was not a secret at all that they were going to hold interest rates unchanged. I'm really surprised the S&P futures moved like it did. It was lower, and then when the announcement came out, we rallied pretty sharply. So I was surprised we had that much movement off of what I thought was going to be a very much a non-event. Maybe they looked at the Fed seeing a 50-point basis cut in 2025, implying 2 quarter-point cuts at some point this year, and looking ahead into the futures market and thinking that would be good for the stock market, and that's why we rallied. But certainly that would be positive for the stock market if that's what the Fed sees, if they see this economy doing a little bit better and improving, and it would bode well for the stock market, I think, going forward from here.
Brian, a lot of times we talk because many of those who are tuned in understand what we're talking about, whether we're talking about, corn, price of corn, or we're talking basis of wheat, or we use a lot of these different terms, but can we step back just a moment on the importance of the Federal Reserve and what would that really mean? I mean, how do we break it down to kind of the farm level? What the Federal Reserve mean for the farm level, the farmer, the rancher there?
So probably the biggest influence that the farm economy would see is off of it, what they do with interest rates, because the interest rates that the Fed funds are setting, your local bank, your lending institution is going to charge a rate something above that level, and they call the difference a spread, kind of like we talk in commodities about basis. This is the basis for a bank is their fixed costs, their employees, their salary costs, all gets added into that interest rate. And so a lower Fed fund rate, usually a bank will have maybe a 3, maybe a 4% spread from where the Fed fund rate is until their loan rate. So that's how a lot of those rates are established, and that's the biggest way a farmer would be affected. Low interest rates at the Fed level will mean lower rates at your local bank level and your lending institution, and that way you have a little bit lower interest rates when you go to borrow your operating costs, your machinery costs, your land costs, that sort of thing. So that's your biggest tie-in, I think, as a farming community. Plus, you look at lower interest rates usually is good for the economy overall. When businesses have lower interest rates for their borrowing, they can pass some of that savings along to higher wages for employees. Usually the economy is a little stronger. Consumers are spending a little bit more money. They have a little bit more disposable money to work with. So that helps out. When they have a little bit more money to work with, you're talking about maybe tractor sales or pickup sales, equipment sales are increasing a little bit as well. So everything is, that's why I like economics. Everything is tied together. It all depends upon each other, and you see that directly related in the form of interest rates.
All right, row crops, corn, mixed territory on Wednesday with the new crop in the red. Soybeans were lower across the board. Soy meal finished lower. Soy oil mostly lower. and the wheat market giving back quite a bit of the gains. I had here hard red with a 34.25-cent gain Tuesday through Tuesday. And if that's the case, let's see, 10-cent loss or so. We're still up, though, 24 cents on hard red. Any thoughts on wheat, and have we gone too far?
The markets, I think, always go too far. They go too far up. They go too far down. They stretch out too much, and then they kind of meet where they should go to. And we probably, that 34 cents is probably too much of a rich premium. I don't know that we're going to have a lot of crop damage. I think there'll certainly be some across some areas where they have heavy winds and some of that crop gets uprooted. But the question is that too much? You know, it's something that we answer down the road, but it certainly appears that was a lot of premium. And I think yesterday's action pulling back off the highs, today's action trading lower, kind of tells us that same thing, that maybe the market got overextended, carried away of itself, and now is starting to see a little bit of a correction in here. Now, we may see this correction find some buying interest, find some support, and see another move higher. There wasn't that much snow that really fell to help out this crop or protect it. It's kind of in that Nebraska area. Maybe northern Kansas had some, but certainly southern Kansas, Oklahoma, that crop is still very vulnerable to any type of yield robbing prospects. So, you know, we usually get into the spring time frame. Sometimes we have some really cold snaps. A lot of times that's around Easter, and Easter's a little bit later this year. If we have something that was cold during Easter, that late calendar date tells us that the crop is going to be in its reproductive phase, and that could really damage that crop and really put a fire into this market as well.
All right. We'll take a break. When we come back, we'll look at livestock futures ahead of a cattle on feed report. Commodity Wrap continues in a moment. This is Commodity Wrap. I'm Tony St. James. Special guest here this afternoon is Brian Hoops. Brian is President, Midwest Market Solutions. All right, Brian, cattle on feed report set to come out on Friday after the close. And, again, I'm kind of looking at the ranges here, 97 to 99 on the on-feed number. The placements, low-end guess 79.1. I think the high end is 90.5. And the marketing's a little tighter, 91.2 to 93.2. But I throw all that out. How important is this cattle on feed report for the industry?
Well, it's going to be very important, I believe. And I do want to mention, before we go down this path, that there was another announcement today from NASS that is kind of flying under the radar that will be of major importance. They have reissued the cattle inventory report in July. So they're going to go once again with county assessments and estimates for livestock and for crops, and they're reinstituting this report that they took out last year. So the July cattle by inventory, semi-annual inventory report is July the 25th. I know a lot of producers missed it last year because it doesn't give us that as accurate information of what inventory is actually out there. But this report we're going to talk about on Friday, this is going to be kind of a key report. We're expecting placements to be sharply lower than a year ago, telling us that contract highs that we're seeing this week in feeder cattle, some of the deferred cattle contracts are justified because we have so many cattle that are not on feed and not being even placed into the feedlots like we saw a year ago. It's going to create some very tight supplies. Really starting here in the second quarter of this year, we're going to see probably 2% less on-feed supplies, and then it gets tighter as the calendar year goes on.
You know, it was interesting. I heard from Darrell Peel earlier, Oklahoma State livestock economist. He was in Mexico talking about the drought conditions there and how they're really scrambling with their feeder cattle trying to figure out where do we go. And again, not necessarily that we're we're completely reopened and we've got a fresh supply coming across. We're not quite back to that point, so that could have an impact on this report as well. Would you agree?
Oh, absolutely. Yeah. We have not really even heard how many cattle are starting to come across, but I don't think it's anywhere close to being like it was, before the border was shut down because of the screwworm. So we're just having a hard time getting handles on how many cattle are moving across the border. But I don't think it's as many as what the trade had dialed in, and that's why we've seen this huge rally in this feeder cattle market.
Okay, before we let you go here, just final thoughts on markets in general. I mean, on a day where we keep making, new highs in some of our markets, especially cattle markets. Final thoughts?
Yeah, it's kind of quiet, kind of choppy in some of these grain markets, except for wheat, which has had some pretty big swings. But boy, cattle have had a great rally, tremendous rally, and it's a supply-driven type rally. Demand picked up once again once we had dropped the values low enough but we're back to focusing on supplies. That'll happen at some point here, I think, in the grains as well, where we start focusing on supply. In fact, we're starting to see that on wheat with this rally because of the very windy conditions. That could definitely and probably has hurt the supply of the wheat market. Now, if we get into the spring, summer growing season for corn and beans and we start to hurt the supply of U.S. corn and U.S. soybeans, we can really see some big price swings, I believe.
And one final thought on the livestock. On my perspective, when I look at live cattle, I look at feeder cattle, everything I've got on the screen here in front of me, they all start with a 2 and have 3 digits before the decimal, which means live cattle, everything on my board here is above $200 at the settlement. Everything on the feeders above $286. Brian, if we want to talk more with you, how do we find you?
I can be reached at our website, MidwestMarketSolutions.com, or you can call me directly at 417-501-5132.
Brian Hoops, President, Midwest Market Solutions on Commodity Wrap.